This is Matt Porter from Cornerstone Financial Advisors in Idaho Falls, Idaho. Today I'm going to have a conversation with a good friend of mine, Brett Jergens, who's the Chief Investment Officer of Prosperity Advisors based out of Kansas City. We do a lot of work together, and Brett is an amazing resource for not only me, but also for my clients. So we want to have a conversation today about the market. I'm going to have some Q&A with Brett that I think will be of benefit to you as a client. And so with that, I think we're going to go ahead and jump right in. So Brett, tell me your current views on the market. How are you feeling about things?
So I think first we just got to clear our brains when we think about the markets, because sometimes we get fed a lot of misinformation, especially from those cable news channels that like to sometimes just tell us all about the warnings and the fears, because that all ultimately gets eyeballs and sells TV time. But we got to take a higher perspective and actually look at some of the facts. One of the best metrics, obviously, is just the stock market performance to tell us how it's doing. In fact, this year, we're off to a very robust start. Through the end of May, stocks, as measured by the S&P 500, are up 9.7% year to date. And fixed income, our bonds, are doing well on the same metric, up 2.64%. So as we can see, both bonds and stocks are doing very good. Also, some of the leading companies in the world, all the household names that we use every day, the Amazons, Microsofts, Googles, NVIDIA, Berkshire Hathaway, just to name a few, the returns on average are above 44%. So as you can see, the best names in the world are doing very good to start the year. Two other measures that I look at to just kind of talk about how the economy is doing is first, earnings. Earnings for companies have been extraordinarily robust. On a year-to-date basis, 77% of companies have reported earnings that are above analyst expectations for both revenue and for underlying earnings per share. When you look at this on a combined basis, the year-over-year growth for companies in the first quarter of 2023 have grown their revenues by 4.3%. So we've definitely seen the rebound from the third and fourth quarter where earnings were slumping of last year. So that's a good trend. Hopefully we see that continue. The last point I'd make just to look on the economy is to talk about unemployment. Unemployment is near all-time lows. We've got a chart here where you can actually see unemployment is below 4%. One of the lowest periods on record. So earners are continue to work, wages continue to get paid, and the consumer continues to spend. All great signs in the economy that shows just the strength that we're seeing when you look at the underlying data points.
That's a great update. So it sounds like there's some reasons to be optimistic out there, which is really good. You brought up an interesting point about the news cycle. You know, I can pretty well determine what's in the news based on the questions that I get, because you definitely see themes. And one of those themes now is inflation and the path of interest rates. So I'd love to hear kind of your thoughts on inflation, what's going to happen there, where we're going with interest rates, those types of questions.
When we think about the thoughts and the path of inflation and interest rates, we're seeing some pretty drastic trends. If you think back over the last couple of years, obviously inflation was very rampant and out of control, especially as we headed into 2022. Inflation actually rocketed from low levels around 2% to above 9%. This was the highest level of inflation that we've seen in over 40 years. So to say the least, it was actually pretty unprecedented. So with high levels of inflation really across all goods and services, the Fed had no choice to significantly increase interest rates. The chart here shows that in the black is when the Fed started taking action in the middle parts of last year, increasing rates to the most we've seen also in a 40-year period. So the Fed's been very aggressive on their tightening actions to slow down the inflation and just the overheating in the economy. We're actually seeing inflation, because of the Fed, start to tail off. Inflation, as I mentioned, peaked over 9%. Today, we're sitting at just above 5%. And the expectation is inflation is going to continue to moderate, hitting somewhere around 3% by the end of the year by most economists' expectations. So definitely a good trend. Also with that is probably a signal that the Fed has done its job as far as increasing the levels of interest rates, which means they're comfortable about where the economy is. And actually, this is a fantastic news for investors. Historically, when you look back on performance of returns across different periods after the Fed has paused interest rate hikes, returns for both stocks and for bonds are extremely robust. On average, the 1-year forward returns for the stock market are above 16% over the next 12 months. Pretty amazing to say the least. Small caps and mid-cap stocks also do extremely well, outpacing on average the S&P 500 16% return. Also, you can see that fixed income investments do very good as well. Bonds, surprisingly, all being that they're supposed to be safe, actually return almost 15% when you're looking at high quality investment grade U.S. bonds. Not to be outdone, U.S. government treasury bonds, known as the safest bond in the world, is up over 12% when you look out 12 months past a Fed rate hike. So as we can see, return expectations based on history are very exciting to say the least.
Well, that's great news. Obviously this cycle has created a lot of fear for investors, so it's good to have some of that historical data that we can look at. So Brett, with that said, what are some of the long-term themes that you're seeing as potential opportunities for clients and investors right now?
So when we look at long-term potential investment thematics, Matt, I think there's actually a lot of good signs and things to be interested in going forward. I think the ability for U.S. businesses to innovate has never been more robust. One of the most exciting themes that we've seen lately is artificial intelligence, or AI. This really kind of broke out over the last handful of months as ChatGPT has become more of a household name, one of the leading AI software applications. With this, many economists and procrastinators are suggesting AI could actually be more important to the world economy than the iPhone or even the internet. So the growth opportunities within artificial intelligence, we're just starting to scratch the surface. And all companies are pretty much trying to figure out how this is going to play out in their businesses respectively over the next decade plus. But it's nice to say that AI is going to be a huge theme, and millions, if not billions and trillions of dollars are going to be spent on trying to develop AI within all types of businesses. Pretty exciting, if you ask me. The next opportunity that I see as a long-term thematic is e-commerce and digital payments. As we know, we've gone away from paying for goods and services using cash. Coins and checks have really much become a thing of the past. The U.S. digital payment market has started to skyrocket over the last 5 years. That trend's not slowing. We think e-commerce has the opportunity to increase by over 18% on a compounded annual return basis through the end of this decade alone. With that, there's going to be new applications, new providers, and ways for businesses to do transactions, which ultimately mean potentially for higher stock prices for companies that are leading in this specific sector. And the last sector or segment or long-term thesis that I would offer up is regarding healthcare and biotechnology. Obviously, as the population and specifically the baby boomers continue to age, companies have an enormous opportunity to find new cures and ways to make people healthier and live longer, more productive and active lives. I think about opportunities within the heart world, within diabetes, and also opportunities to potentially kill cancer and put an end to that disease. So the opportunity in global biotech, for example, is going to be continue to expand. In fact, current estimates is that $1 trillion will be spent by 2030 developing and implementing new cures for different healthcare items. So another huge growth potential. With that, obviously, stocks will be involved, and companies that make those leading cures will be at the forefront of the highest stock returns over the next decade.
No, those are great subjects. It's an exciting time that we live in, and so many of those are technology driven, these advancements that we're getting. And there's a lot of reasons to be positive. I appreciate you highlighting the ones that you did.
Everybody wants to know is this market going to be different than what we've seen in the past? Throughout my over 2.5 decades of experience investing in the market and even significant hours researching the market, what we always come to find out is the market is really not that different. In fact, the market runs in cycles. I like to say sometimes the market is similar to going out and riding a bicycle. If you think about riding a bike, obviously you don't pedal in a straight line. You go up and down hills, you take to left turns, you go right turns. And if you think that is really kind of similar to what the stock market does, it goes up and down and turns quite often. But when you look at the long-term trajectory, it moves higher and to the right over the long term. Just like a bike ride, you ultimately get to your end destination, similar in the stock market. So this time, to me, is not really different. We just have to understand that the equity markets are going to do what the equity markets do, and that is go up and down, but over the long time, they go higher. And that's a good trend if you have a good mindset as an investor.
That's a great analogy. I like that because I'm a bicycle guy. So that is a great analogy. Brett, one thing that I get asked periodically is, does it make sense to try and just sit this cycle out? A lot of people can potentially sleep a little bit better at night knowing that their money's outside of potential riskier assets. But is that a strategy that makes sense?
A lot of people ask me, Brett, why don't we try to time the market? And to me, timing the market is really a fool's errand. Many people have tried, and many people are very unsuccessful. The simple fact of trying to get the moves of the market and the crazy gyrations that we see on a short-term basis is all near impossible. For example, this chart shows when 22 of the 25 worst days happen in the market, it's often followed by some of the best days in the market. So if you look at the returns of the S&P 500 over the last 20 years, if you just stayed in invested the whole time, $100,000 would have translated into $425,000, the best returns by far. However, if you were sitting out in the market and just missed one day, your returns get impacted negatively, going down to only $381,000. However, if you just miss a handful of the best days, your returns over the last 20 years are cut in half. So pretty significant if you just miss a few of the best performing days. That's why it's critical in our mind that investors stay invested throughout the cycles. That ultimately produces the best return results.
That's great counsel. Warren Buffett's given us a great example of that. So with that said, if we're encouraging people to stay focused on the long term, and you've already kind of mentioned some ideas here, but why don't you give us a few more reasons why we should be optimistic right now?
Reasons to be optimistic? Man, I could go on and on. There's a whole host of opportunities out there that we just talked about on the thematic side. But in general, I think there's a lot of signs and reasons to be optimistic. First, we got to understand that the market is always facing challenges. Here is one of my favorite quotes from a long-term investor, one of the best ever to do it, Peter Lynch. And he says the real key to making money in stocks is not to get scared out of them. And I think when we're looking at markets, if you think about this chart that we show here about the resiliency of the U.S. stock market, we're always facing challenges. There's wars, there's debt issues, there's U.S. government political potential changes that scare investors. But if you see, those are just blips on the small radar screen, and they're always happening. But yet the stock market continues to move higher over time. We have to keep in mind that that is how the stock market works. Furthermore, we have portfolio diversification. Based on individuals' risk tolerance, we've developed portfolios that are in line to take advantage and understand that there's going to be volatility in markets. For example, I think back in my younger days when I was a whole lot skinnier and in better shape. I played football, and actually I was the quarterback of the team. And when I think about portfolio diversification, it's very similar to playing football. As a quarterback, there's sometimes the wide receiver is going to be open way down the field. Or you've got a great, huge tight end that you can throw lob passes to. Or sometimes it just makes sense to hand off the ball to your running back for a nice, steady gain upfield. And that's very similar to how we think about portfolios. Not all investments are going to work all the time, but there's going to be certain areas of the portfolio that we're going to have investments to, and they're going to be in favor. And that's where we want to be allocating and tilting our portfolios to. So the last reason that I would offer up is why we want to be optimistic. I think if you look at fixed income, we have an opportunity that as investors we haven't had in 15 years. As a result of low interest rates, you couldn't really earn any interest on checking accounts, money markets, CDs, really paid nothing. But as a result of the Fed embarking on its interest rate hikes over the last 18 months, investors now have an opportunity to allocate capital to high-quality bonds, CDs, and money markets, all offering attractive rates ranging anywhere from 4 to a little over 5%. So pretty attractive opportunity for high-quality investing and low-risk investments. So if you're a bond investor, this time you can actually be really excited. So I'll sum up, my thinking as some of the highlights. One, the market is doing very well. The economy is very robust. Unemployment is low. Consumers have increased wages that they continue to spend on goods and services. There's a lot of investment thematics that are getting very exciting and have multi-decade potential investment opportunities that can generate high levels of return. And lastly, we got to understand as investors the investment cycle. There's always going to be ebbs and flows in the market. That's just the normal course of action as investors. We have to understand that's how the markets just work. But if we ride it out for a period of time, the markets are undefeated at moving higher to new levels over the long run.
I think every once in a while it's good to have just a few reasons to be optimistic. News cycles can dominate, can beat people down, and it's good to take a step back and look at the bigger picture and see what is out there. Why should we be optimistic? What's coming in the future? What are we looking at from advancements in technology and different things like that? So great thoughts. Thank you, Brett. That will conclude our time together. I want to thank you, Brett, for spending a few minutes together and getting to talk through, some of your thoughts on the market and these interesting times that we're living in. We really appreciate your time and thank you for doing it.
Yeah, thanks, Matt. Appreciate the opportunity and look forward to working with you going forward.